Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at a couple of different things. We're going to look at money velocity, and we're also going to look at the DXY to the 10-year yield as a ratio. What somebody at work had brought up, they were looking at the DXY to 10-year yield, and they took a stock and inverted an oil stock, and it looks very similar. And I'm going to show everyone what that looks like. I'm going to do a little bit of other analysis where I don't invert the oil curve and show you straight up kind of what we're looking at. And also, we're kind of coming to a decision point here where we could break out to the downside of this ratio, signaling a much larger move in oil and energy in general, energy stocks, I should say. I should say oil in particular, oil stocks. I don't see this relationship with anything else. I've tried mirroring some other things like Camco and some other uranium companies, and they just don't mirror up very well. So let's look at the ratio. I'll try to describe it as best I can and give you my opinion on it. It is something I'm playing with. It is new. I did add it to all of the information to the website, so you guys can check it on the website and what my thoughts are around it kind of initially. But let's walk through it together and let's see what I can come up with here. So we've got the DXY to US 10-year yield here. And what we see is a large expanding wedge or megaphone pattern. You could also throw another kind of a trend line through here as well and call this a capitulation bottom. What this is signaling from this time frame is a disinflationary period. And if you think of the ratio, the DXY in relationship to the 10-year yield, it means that we would have an increasing movement with stronger relative dollar, and weaker yields in relationship to that stronger relative dollar. That's the environment that we've been living in. And most everyone, I was born back in this 1981 was when I was born. I've been living in this paradigm of a DXY increasing at a faster pace than yields, at least that relative strength indicator. Now, when we look at it, we could be playing with this bottom trend line where we could potentially break to the downside. We've got a whole ton of momentum coming right at it and not much of a bounce at that line, which means more than likely with yields breaking higher, with the dollar kind of topping out here, we could see this break down where the DXY becomes, we'll call it relatively weaker in relationship to the 10-year yield. And I think that has some profound effects on some of the things that we measure. And one of the things that he did is he took one of my favorite oil stocks, and he took the DXY to the US 10-year, that same ratio, and then he did 1 divided by SM. So he inverted SM Energy's chart and overlaid it on each other. And you can see that they actually move up and down and correlate quite well to each other. This here, when the orange line goes up, this is actually a crash in SM Energy. This is also a crash in SM Energy. This is also a crash in SM Energy, and this is the recoveries. So remember, this is inverted. Now, when you think about it, a weaker dollar and stronger 10-year yield usually mean you're in an inflationary period. So you could say that when this ratio declines, that you're in a favorable period for oil. That you're using oil as an inflation hedge, so to speak. So when we decline here, oil prices go up, and this is inverted. Remember that this here is inverted. I know it's kind of hard to think that way. So when you don't have an inverted one, and I've got this, and I know it's a little bit busy here, but we can describe it here. This is the full data here. I'm using it on logarithmic, and this is the oil price in the bottom. It's not inverted. It's just oil price, and then the DXY to TNX above it. Inflationary periods would see a declining dollar with an increasing 10-year yield. Think of it as an inverted yield curve, or things that go to invert. Over long periods of time, we see this as an inflationary period as this ratio declines. Then we go into a disinflationary period from 1980 onward, and we see a disinflationary period all the way from 80, 81, 82, all the way to the bottom of 2020. Now, are we going into a new inflationary period going forward? That's what I've got this question mark here for, and kind of the beginning of 2020. And we've seen that decline in this ratio, and that's when oil has gone ballistic. What I did is I put the bottom, or I should say that the ratio topping is the bottom of the oil price. And you can see these green lines. If you look at declines, you can see that the declines are mirrored inversely relation to oil. And you can see there's a large decline here. There's the big upward move in oil. You can see a decline there, an upward move in oil. And then this was relatively an increase with not too much of a decline, and it just went sideways. So the DXY TMX going lower is fuel for an inflationary move or an increase in oil prices. And that's just saying that we're getting a weaker dollar and or a stronger 10-year yield, or a combination of both of those things. Or a 10-year yield that goes sideways and the dollar that weakens. That would also work. And I think that type of environment is coming for us ahead. Now, another thing that I wanted to look at was the money velocity, because this also ties into this as well. And one thing that I noticed here, and this is a long-term chart, money velocity remained relatively stable all the way till about 1991. We kicked up in 91, and then we had a large decline in money velocity. I don't know if that's because of certain things of how they measure it. I don't know if there's stimulus that comes in here that can't make its way into the world. So it's kind of locked up in banks, locked up in financial products, locked up in stocks or whatever. But one thing I wanted to show here, guys, is look at this last kind of portion here. We're almost kind of rounding up and starting to move higher in money velocity. So if I zoom into a 5-year, what's going on here? We've been basically going sideways. And I'll go over what money velocity is, over the definition and whatnot. But we're going sideways here, and we're kind of kicking up towards the end of this. That kick up there is an increase in money velocity that we have not seen in a very long time. So if I were to go out the last 10 years, this has basically been moving down, 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 down. We had a little bit of a kick up in 2017 and 2018. That's when they increased interest rates, and then it rolled back over and ate it. But we're kicking back up again. We've gone from 1.131 all the way to 1.165. I don't know if that's a huge move, but we're kicking up in velocity. And with as much money in the system, I think that is having an impact on inflation. So I wanted to go over the definition of velocity, go over the equation here real quick, and talk about some scenarios. The velocity of money is the frequency at which one unit of currency is used to purchase domestically produced goods and services within a given period, within a given time period. In other words, it is the number of times $1 is spent to buy goods and services per unit of time. So it's dollars per unit of time, and that is your velocity. It's your purchasing power divided by time. And if you look at the equation here, it's the velocity of money is VT for all transactions in a given time frame. P and T. So P is the price level, T is the aggregate real value of transactions in a given time frame. And then M is the total nominal amount of money in circulation on the average in the economy. Now, remember, they pumped the M in this equation. They pumped it way up. Now, in order to get velocity, you're going to have to get either your price level has to go up, or your aggregate real value of transactions in a given time frame goes up. And I think what's going on is if we have a shortage of products, we don't have as many products in there, the price level is definitely going up. We can see that all around us. But I also think that the velocity here, the aggregate real value of transactions in a given time frame, is also increasing. So we haven't seen this in a very long time. We usually see the velocity of money kick up during certain demographics coming into home buying years. They want to buy more stuff for their homes. And it seems to be aligning close with that. We also had stimulus money come into the system, and that might be being spent as well. So inflation also has this velocity of money component in it. And we're seeing that velocity start to kick up. We're also seeing that same type of movement in the DXY and TNX type environment as well, which is aligning with everything. We're getting this nice alignment. The question that I have, and I think that a lot of people have that are investors, is the stimulus a one-time deal? Is it going to slow back down after the stimulus money kind of works its way through the system? Or is this more driven by an energy crisis and an energy shortage, which will continue to drive the DXY down and the TNX up, which is a function of an energy crisis? And which one's going to win out? Because an energy crisis will be sustained by increasing dollars in the system. Now, there's another component here that is also coming up, and that deals with your bonds. You could also be coming into a bond crisis where you get a large sell-off in bonds, and banks will come in and buy bonds. That is also going to be inflationary. And I know some people say it's not inflationary as long as it stays in the banking system. I don't think that for them to stop this, you could have a lot of banks own bonds, and yes, they could buy it. The central bank could buy bonds from other banks, but it may also be buying it from other entities, which then would be inflationary because you're putting money back into the system. We're seeing that central banks are stepping in and slowing the 10-year gilt. So that's 10-year UK gilt, which is this guy here. They're coming in and they're actively buying some of this and trying to slow this move down because it was basically collapsing. And they came in and bought a whole bunch up this past week or so. But this is bonds here. This is a 10-year bond of UK, and it is literally falling off a cliff. It's basically on the fringe of a currency collapse. Bond crisis, currency crisis. And we're seeing people run to safety in the form of precious metals and stuff like that. But we're also seeing not just that, but the bond prices also of America, the 20-year, has also ripped to the downside. We've seen a huge loss of purchasing power against bonds. And commodities have definitely preserved the purchasing power against bonds and stocks and other and currencies. So I wanted to bring that up as well, show you guys that this is all interconnected. The inflation, the velocity of money, bond prices getting hit, and an energy crisis. The question that I have for everyone is, you can put it in the comment section, your answer, is the inflation going to be temporary, or is it driven by commodities and energy crisis? I think that's what it is, but there's also the component of how much money is in the system, credit expansion, and all that. But if you look at the scenario that we've gone through, we've had all of those kind of happen at the same time. We've had an increase in the money supply, and at the same time, we've had an energy crisis. And it's very much similar to the 1970s, but across the entire globe. So we've got very interesting times that we're going into. I think it's going to be inflationary for a while, and I am driven from the supply side problems. The disinflationary period was driven by a few different things. I think cheap energy, cheap abundant energy was one of those things, and I think that is being taken off the table. I also think that commodities or plentiful commodities were also a factor in it, and I think that that's going to tighten up as we go forward, especially a bunch of essential commodities, cheap labor. There's a couple of other things as well, and I think this is all rotating. So that's what I've got for today. I kind of wanted to share what I've been looking at. The DXY in relationship to the 10-year yield. Basically, what it's telling us is the market conditions. And we've seen that big move down to the downside, which is showing us that it's a right market condition for oil. And I think oil's the driver of it. I don't think it's the DXY to 10-year yield driving it. I think oil's driving this boat. If that is the case, I think we're going to see a continuation of that DXY to 10-year yield drive down. Weaker dollar, stronger 10-year yield will probably invert more, and I think that the oil prices will continue higher. My guess, this winter and also into next year. So that's what I've got for today. Hopefully you guys found some value in it. Give me a thumbs up for the content. Subscribe to the channel, and don't forget the website. Subscribe to that as well, Platinum membership if you'd like to join. And we'll catch everyone later. This is Finding Value.